The U.S. jobs market defies expectations in June. What does this mean for the Federal Reserve? Joining us today is Sam Stovall of CFRA Research. All right, Sam, the U.S. economy added more jobs than expected last month. Yet the labor market data earlier this week wasn't as strong, and we saw the latest inflation numbers drift a little bit further away from the Fed's 2% annual target rate. So, what do you think the Federal Reserve's next move is in terms of interest rates?
Well, I think the next move for the Fed really is to remain on hold. The data came out strongly this morning. The bond market saw interest rates rise a bit in response to that. Also, the expectations for a Fed cut were delayed to September, probably at the earliest. So, people are waiting for the next shoe to drop. But what we find is that the economy continues to remain resilient.
Speaking of the next shoe to drop, what do you think of the July 9th trade deadline, which is approaching, obviously? If we don't see more trade deals or some further clarity about trade policy, how do you think the market will react?
Well, I think the market is expecting the trade deals to continue and would not be surprised if the president announced a further delay. And investors would be saying, tell me something I don't know. But because of the most recent agreement with Vietnam, I think investors are humming the song, Another One Bites the Dust. So that is encouraging that sooner or later this trade issue will get out of the way and the market can focus on what is known.
We have a Queen reference. Very nicely done. All right, let's move on to Nvidia, which is on track today to become the most valuable company ever, with a market cap nearing $4 trillion. Are there any vulnerabilities to the AI trade, or are we just full steam ahead?
Well, certainly when you look to other companies in the past that were the most valuable, whether it's IBM or Exxon, you have to say the only place it can go is down. However, I think with Nvidia now being the most valuable of all time, it shows that time has moved on, that inflation, that prices have increased, and it also shows the importance of tech in general and AI in particular. So I think that the implication is that even though we could always see some digestion of recent gains, that technology really will likely be the driver, at least for the next few years to come.
And speaking of digesting of recent gains, we've been hitting all-time highs with the stock market, with the S&P 500 and the NASDAQ. Can that continue, or will we see another pullback like we just saw pretty recently in April?
I think the market's hitting new all-time highs is something that is likely to continue, and that's not just my opinion, but rather history. If you go back to World War II, you realize how swiftly we went from a new all-time high on February 19th to a 10% correction. That was only 22 calendar days. Swift declines tend to imply shallow sell-offs and fairly rapid recoveries, which is exactly what we got. Also, history says that we tend to advance another 10% before being vulnerable to a decline of 5% or more. So I still think, at least in the near to intermediate term, meaning over the next several months, we still have upside potential.